Good morning and a warm welcome to our Investor Day participants today, both here in the room and also out in the web. I think in the run-up to this day, it's a fair statement to say that there was a healthy dose of interest. And so we appreciate everyone's attention. I can say that on behalf of everyone at Nestlé. We really do appreciate it. Thanks for being here. Thanks for joining us. When you look at the format of the day, Stefan outlined it. This is not going to be a tops-to-bottom review. So this is not a format like the one that some of you attended in Switzerland in May 2016. Hence, it's not the entire executive board presenting. We wanted to keep it short and sweet and focused. We wanted to outline the main strategic direction and the financial model behind it. But I can assure you that what we're presenting today, what you will be seeing, hearing, and learning, is supported by the entire executive board, by the entire leadership team, is carefully aligned. We all stand behind this. We want to make this happen. Stefan has pointed out the safe harbor language to you, so let's go right to my summary slide with key messages for today. And the first two are really about the careful alignment in the leadership team, the executive board, and our board of directors about what needs to be done. And most of all, about a sense of urgency, going about things promptly in a food and beverage industry that is changing fast. And so we're committed to this. I think that time and time again today, during these presentations, you will see our strong commitment to change and taking advantage of change in the industry that we're serving. We do believe that we know where our strategic sweet spot is, and I'll be talking about this in a few minutes. And I think that strategic sweet spot is important because the market, this is the positive message, is moving in our direction. The market is moving in our direction, and I'll try to explain that to you later. In all modesty, I think, and you will see this in the presentations today, particularly by the zone CEOs, we get the new consumer. We also get, in all modesty, the opportunities offered by the digital transformation in our industry. And we do get the need for improved efficiency, hence the margin target that we announced today that we're committed to. And I think that should put some of your concerns from the past to rest. And then at the bottom, as we go about this, we will stay true to our purpose and values. That is important to us. So things will change, but the way we do business, the way we approach business, the way we approach our business partners, that is not going to change. I think that's important, that's reassuring. And as we go on this journey, I think we're poised to deliver substantial shareholder value. Now, on the next few slides, what I'm trying to do is give you an overview of where I see some of our strengths, some of the areas that I think we have to work on. Then I'll try to give you an overview of what I perceive to be that changing environment for fast-moving consumer goods companies, and then I'll be building up to our strategy to cope with this environment. And this builds on my personal conviction that when you develop strategies for a large, iconic company like this, you're not doing a greenfield exercise. You basically build on what's there, and then you take into account how the environment is changing and how to take best advantage of that situation. And that's the approach I'm trying to take you through. I won't get into all details on all of these strengths. Let me just highlight one, which I think is key, and that's the fourth bullet point, our nutrition, health, and wellness strategy. We've been at this now for 20 years, and I think it's showing specific, concrete results. I think that we've been working steadily, more than we get credit for, on improving the nutritional profile of our food and beverage offerings. And this is exactly where the market is going very fast. And I think we're starting to get more and more credit for this. I think you get to sample some of these products today. I think the consumer over time will appreciate that we bring a lot to the table when it comes to healthier choices that are yet at the same time delicious and convenient. When it comes to areas for improvement, again, not surprisingly, this whole notion of accelerating that strategy is at the top of the list, because the market is changing. I think this is the one thing that we are all learning in the food and beverage industry that's probably surprising to even some of the old hands in the industry, that this industry has started to accelerate and change of pace has picked up. And hence, we need to go in that direction even faster. We need to execute faster than before. In this process, we're committed to boosting organic growth because I know that that has been a source of disappointment for the last few years. We are also committed to balancing our growth aspirations with improved margin and profitability. Hence, this whole notion of efficiency, something that Francois has been spearheading now for years, this is an issue that I think gets a lot of attention inside the company. And we're also committed to improving, on a constant basis, capital efficiency, which I know has been another area of interest for many of you. As we make this happen, we will need to optimize our portfolio, so there will be some portfolio changes in addition to a whole lot of internal work that we're committed to. And yes, we will need to drive speed and simplicity in our organization. That is a message that resonates very, very strongly inside Nestlé, and we're fast working at it. This next slide, which describes some of my takes on the change in the fast-moving consumer goods industry, I've shown this before. I've shown this in Berlin this summer as part of a consumer goods forum, which is an industry gathering. So some of you who watched that video, it may be a repetition, but I think it's worthwhile to cover it again, because in addition to some of these individual phenomena that we will talk about time and time again today, what I'm also trying to do is to give you some of the connections between these trends, some of the mechanisms of action that link those. So let's start at the left-hand corner, the top, the change in consumer, because for a fast-moving consumer goods company, things do start with the consumer. And it's not only about millennials, if you're wondering, but the millennials are important. They're important because this is a group that's fast approaching their peak earning years. And one of the wisdoms in the consumer goods industry is youth rarely goes out of fashion. So whatever the millennials do, over time you can count on the fact that their behaviors, their preferences also get picked up by other generations and get emulated, basically. So watching what they do, what's of interest with them, is very important. Catering to their needs is very important for any fast-moving consumer goods company. And while I won't do a comprehensive analysis of all the facets of what constitutes the millennials, let me highlight a few. For the first time in many markets, in decades now, we're seeing an improved willingness to spend on food and beverage. So from disposable income, spending levels on food and beverage are going up. This is a very discerning customer group, but for the right product, for the right level of quality, for the right story, they're willing to spend. And I think that's very reassuring. That has not been the case for decades. Second, everything related to health is front, left, and center. I think this is a generation that, starting from the days in school, has had a totally different level of nutritional background compared to previous generations. And on top of that, the internet makes it so easy, even for those who missed it, who missed that class in school, to pick up, get it on Google. Google can be a very, very, very good nutritional advisor. And I think people have discovered that. So the whole level of awareness and knowledge of what constitutes good food and beverage has dramatically increased. Third, when it comes to global companies and global brands, I think there is a change. 30, 40 years ago, being global almost automatically meant this is cool. So the latest product from America or Japan automatically seemed to have a head start because it was coming from somewhere else. It had that exotic appeal. That has changed. And I think these days the head start belongs to a lot of the local things that seem to be closer to us, where we can build up trust. Doesn't mean that global brands, global products go out of fashion. I think Patrice will cover some of this in the afternoon. But I think global brands, global companies do have to go the extra mile to build up trust with the consumer and to get their confidence. And we're committed to doing that. And last but not least, there's a whole new level of interest in how a product is being made. So what does the supply chain look like? What are the business practices of a company engaged in doing this? It's no longer sufficient just to be the respected quality company. You need to be liked, in Facebook terms. And so people want to feel a level of sympathy towards the product and the manufacturer. Then they're willing to engage. Now, moving one over to the right, digital. I think this is also a generation that digitally is very much switched on. Digital is a game changer in our industry, and in particular in the retail side with our retail partners. I won't cover all aspects, but let me focus on two, and you will get a lot more detail later on in the presentations from Wan Ling and also from Patrice, who are our thought leaders in that space. One is, when it comes to communication, this is the first time in history where at scale, you can really have a one-to-one communication, two-way street with a consumer. The old model of what I call push advertising, where you develop a product and content, you then try to select media that roughly hit that consumer, and then you hope the message arrives and that consumer will act in a certain way. That model is fading fast. And what you can do these days, once you have a consumer's phone number or email address, you can really target specifically to the needs of that person. You can have, at scale, in an automated yet personal way, a conversation, and you have a much, much better hit rate than any time before. And so this is a huge opportunity. We're deeply committed to making the most of this. And then second, in e-commerce, I think in addition to relying on traditional channels, the opportunity of building up a direct pathway to the consumer, a direct fulfillment model, I think that also opens up whole new opportunities. Now, those two trends, the fact that you can get out a word about your product so much more cheaply and directly, and the fact that you also have the option of a direct online fulfillment model, that I think also had an impact on the trend on the far right. And that is the rise of small to mid-sized companies in our space. My personal theory is that 30, 40 years ago, it was probably just as easy or just as difficult to start up a new company in our space, to come up with a new product and then to try to market it. The difference is that at that time, you had to surmount two powerful barriers to entry. One is getting word out about your product without a massive advertising budget. And then the second one is getting listed with one of the key retailers. And it was kind of a chicken or egg problem, but again, it surmounted to two powerful barriers to entry. These days, because of the digital change, I think it has become much easier. Once you have the product, once you have the concept, making it to market has become cheaper, has become faster. And hence, when you look at the last 10, 15 years, the other category alongside the large established suppliers has been increasing steadily in most product categories that we serve. Initially, I think all large companies kind of ignored that trend. I think in recent years, awareness about that has been rising significantly. Now, when you go to the bottom row and start again at the left, that trend, so the fact that there was collective market share loss to some of these small to mid-sized focused companies, coupled with a low inflation or sometimes even deflationary environment in most Western markets, I think that led to the rise of the deep cost cutters, because if your top line was suffering, it's a close step to kind of say, okay, let's take that for granted. Apparently, top-line fantasy is not there anymore. Where else do we seek value? Well, we seek it in the bottom line, and hence the rise of aggressive cost cutters that basically were going after that. And I can understand, if you take a flagging top line for granted, that might be a logical solution. It's not our approach. It's not our way of doing business. We believe that if we want to sustainably build value, it has to be within three elements, and that is organic growth, profitability, and capital efficiency. But again, I can understand how some people got to that conclusion in that particular environment. Stricter regulations, especially for global companies, that is an issue. Regulation, when done right, when based on science, I think can be a win-win for everyone. But we have also seen examples where it was based on politics and flavor of the day. And of course, it's important that regulation, when it happens, is carefully coordinated, because if it's country by country, then of course it saddles the entire industry with a lot of additional cost. And last but not least, macro uncertainty. I think we're living post this financial crisis in a day and age with gyrating currencies and a very sort of sluggish macroeconomic growth. It makes it more difficult for a multinational company, as you are betting on a certain level of interest rates, currencies, and also macroeconomic growth in various markets. It makes it harder to achieve the same result, no question. And you can also see that when it comes to the consumer, the fact that there's so much uncertainty, that transmission belt between good macroeconomic data and then spending habits, that transmission belt somehow is broken. You see that in North America. I think you're also seeing it in some Western European markets. So uncertainty about the future naturally creates a certain hesitancy when it comes to personal spending. Now, In the context of all of this, let's talk about our strategy, and let's spend quite a bit of time on this. The key statement at the top, food and beverage is core. And I do believe that it offers significant nutrition, health, and wellness opportunity. This is 95% of our company. This is what we were started on, and this is what we have to build in and win in. And if you'd like to know then, well, what is that sweet spot that Mark was talking about? Let's turn to the first bullet point, because I think that really captures it all. It's about healthy, delicious, and convenient products for modern time-constrained lifestyle. So let's go through those one by one. What does healthy mean for food and beverage? Healthy for food and beverage does not mean therapy. Okay? Things get confused very fast when you're trying to treat food as therapy. When you have a therapy, when you have an active pharmaceutical ingredient, you're much better served having it as a pill, as an injection, or an infusion, because it gives you perfect control over timing, dosage, and absorption. Once you start confusing therapy and food, it's not a good idea. So again, we're committed to food. And healthy in food means that you're trying to match the body's needs of the 3 macronutrients, proteins, carbohydrates, and fat, and the roughly 40 micronutrients in a near-perfect way. Sounds easy, but it's very hard to do. If you do it, it's inducive to good health. It doesn't cure anything. Okay, it just basically improves your prognosis. I personally believe, coming from a healthcare background, this is the single best form of prevention you can do. But let me tell you, as simple as it sounds, it's devilishly hard, because the macronutrient levels and micronutrient levels that we all need are individually different. And for each and every person alone, at any moment in time, these levels go up and down. Are we hot? Are we cold? Have we worked out? Have we not worked out? Are we fighting off an infection? Yes or no? So actually, what we need at any given moment in time is devilishly complex. That also means that longer term, in addition to just overall contributing to a better matching of macro and micronutrient needs and what we give, there's lots of runway. There's lots of opportunity over time to apply science to basically accomplish that purpose. So I think there's lots of things we can do. There's lots of runway, but it is about meeting the body's needs for macro and micronutrients. It's not about therapy. And that, to me, is a key differentiator. Next up, delicious. I use that as a proxy for all the other things why we consume food. Food is not fuel alone. And if you want to know what I mean, well, talk to former astronauts. None of them would say, well, geez, I'm missing that food that they served me up on that space station. We were able to keep them alive, but they don't want to go back to have a meal. Okay? And so clearly, to me, this whole notion of what are the other reasons why we eat, and how can we cater to those needs, in particular the need for indulgence, for enjoyment, that is a key differentiator. Hence this whole history of 60-40 wins when we test products, this whole notion that a product needs to find favor in its category over and above competing products. That's not going to go away. And then the third one, convenience. Well, if you want to maximize the first two, if you want to maximize healthy and delicious, here's my advice to you. Get a nutritionist, a personal one, get a personal trainer, and also get one of those celebrated New Age West Coast chefs. And you will have healthy and delicious food. But you also immediately recognize the limitation. First of all, this is, to most of us, not affordable. And second, it doesn't fit a lifestyle where you have little control over your timing and exactly who serves you which meal where. And hence, this whole notion of bringing together with health and deliciousness some element of practicality. Once you bring those three together, this is exactly where our sweet spot is. This is, when those three things come together, then our products really make a lasting difference. So if you want a delicious cup of espresso in the morning, I have no doubts that a personal barista from Italy can brew you a perfect cup of coffee. I would just bet that our Nespresso machine does it faster for you. Okay? So this is basically, when those things come together, this is the sweet spot of the company. Anything that goes in this direction can't be wrong. Now, that also goes hand with the second bullet point, and that is premiumization. So a lot of this is consistent with premiumization, that we find in emerging markets and developing markets the same. And when it comes to the poorest developing countries, I think there's also a nutrition, health, and wellness strategy that we can pursue. And that is one based on affordable micronutrient fortification. One link covers quite a few of these markets with her zone. And I think we are seeing spectacular success. To me, it's the ultimate example of doing well and doing good at the same time. So in food and beverage, those areas are clearly promising to us. You'll see on the next page a quick reality check when it comes to nutrition, health, and wellness. But I want you to have a clear understanding. This is our core. This is what we're building on. And then, moving to the second part of the slide, consumer healthcare. This is something that we started 10, 15, 20 years ago, initially based on medical nutrition. Then we've been branching out into some other consumer OTC healthcare products. And yes, like anything that you start with lessons, and you're starting with a mixed track record. So we've seen some spectacular successes, but also we've had a few expensive lessons, and I'll talk some of that about that later. But when you look at some of the trends that we can cater to, I think these are promising trends. One is, with the aging baby boomer generation, lots of disposable income, and this whole notion of healthy aging, I think there's a lot of opportunity for a company that brings science to the table, that has credibility, and that has global reach. Second, this whole notion in increased self-medication interest in a day and age when healthcare becomes so much more unaffordable around the globe. And then, of course, for us, in addition to the grocery channel, benefiting from a larger stance, a larger footprint in the drugstore and pharmacy channel, which by and large offers more growth, more margin, pretty much around the world. So that's the essence of our strategy. And as I promised, just a quick health check and reality check here when it comes to NHW. This is based on our own data because we couldn't find public data on this. But what it tells you is that for products that are in line with our NHW strategy, products that meet our strict NF Nutritional Foundation guidelines, and at the same time find 60-40 favor with our consumers, those products, when it comes to growth, beat the rest by a factor of 1.8. When it comes to profitability, underlying trading operating profit margin, they meet it by 1.5. So clearly, when we go in that direction, we don't do wrong to the company. When we go in that direction, it does pay off. So that concludes the section on strategy. I'm now going to be spending a lot of slides on the next section, and that is on this whole notion of organic growth. For those of you with a good memory, yes, that slide is identical to the one I showed you in mid-February, including then the sequence of the actions I'm outlining here. But what I would like to do now is really give you additional color, additional detail on how we intend to put each of these 5 in place and why. And I'm doing this, and I'm spending a lot of time on this, because one of the core feedback items from our roadshows this spring and also this summer was, well, we hear about your intention of getting back to mid-single-digit organic growth. We'd like to believe you, but are you sure you can get there? And I understand that. And very frequently got asked the question, well, isn't it that 3% is the new 5%? Aren't you permanently relegated to lower organic growth? And hence I felt giving you detail on how we put this in place and what exactly we're pursuing is going to be important. So let's focus first on investing selectively in fast-growing categories and regions, and let's hit the categories first. So you heard me talk earlier about these 4 major categories that we intend to boost in particular, and that is coffee, pet care, water, and nutrition. And when we're saying that we would like to manage those more selectively for growth, by the way, that should not relegate the other categories to second-class citizens. Far from it. All it means is, here, we're trying to manage for growth, which means we're aggressively spent on OPEX, CAPEX, and M&A to advance growth wherever we can. For the others, we're trying to manage more for a combination of growth and value. So this is basically the practical implication. Now, when you look at these 4 categories, collectively, they make up more than half of the company. So any progress we're making in that space will clearly have a tangible benefit for the OG of the entire group. Then when you look at the second pie chart, these 4 product categories have an above average profitability taken together. So as we expand in those, we're not diluting profitability, we're supporting profitability. And then when you look at the bar chart on the right, clearly the average organic growth of these 4 categories is above par when it comes to the rest of the group or the other categories we have. So clearly, as we go in this direction and as we manage to expand our growth in those areas, we will help the company average in a meaningful way. Now, quick reality check again on the next page. This is our market shares in those categories against the next largest competitor. What you're seeing is that without exception, we either lead those categories or we are a strong second strongest competitor. The core message here being, if we invest in those categories, if we invest in OPEX, CAPEX, and M&A, we're not investing in hopeless fights. I think we're approaching those categories from a position of strength. We have a chance to really lift the entire market and benefit from it as the leading industry participant in each of these 4 segments. So what I'll be doing next is I spend 2 slides on each of these 4 categories to give you a little bit of color on their dynamics and also what specifically we would like to do in those categories. Let's start with coffee. I think few people doubt the size and attractiveness of this industry and the fact that we are the leading participant in it. And over and above the financial success and the market share, I think what we bring to the table here is industry-leading brand names such as Nescafé and Nespresso, leading technologies when it comes to coffee processing, deep roots when it comes to sourcing the products, which I think is important for a limited agricultural product like coffee. And hence, I think we have all the elements. We have everything we need to succeed there. Let's do more with that. That's the key message. And so the next slide describes some of those actions to you. I won't go through all of those, but I'll focus on the bottom row. And let me start from the left-hand side with out of home. I know quite a few of you have heard about our Blue Bottle acquisition from just a few weeks ago. This is not our first foray into out of home. And more than you may have noticed in the past, we have had a good presence through our Nestlé Professional activities, either directly or indirectly, in lots of out-of-home locations. Out-of-home consumption of coffee is growing faster than in-home. Both are growing at very attractive rates, but out-of-home is growing faster. We also have started through Nespresso and Nescafé to get into coffee shops, either directly or indirectly managed. And so this is a fairly consistent move now with a very strong and well-loved and recognized brand to do more. So this whole notion, in addition to the in-home consumption, to also, over time, make a stronger push into out-of-home, either by owning the coffee shop outright or by having some of the key distribution points inside someone else's coffee shop. That is going to be a strategic fixture going forward. As part of that, because some segments of out-of-home do require a stronger presence of roast and ground, you will also see a renewed interest from our company when it comes to the roast and ground coffee category. Next up, at the center, ready to drink. What I wanted to assure you is that as we approach the coffee business on a global basis, we're not going to be Eurocentric. This whole Eurocentric approach, well, you can have your cup of coffee either as a small cup or a large cup, black or white, sugar or no sugar. That is way too simplistic. What you see and what's behind the premiumization drive in coffee these days is a branching out into all sorts of opportunities. And as you look at some of the hotter and more exotic climates, clearly there's a renewed and strong interest in ready-to-drink cold coffee. Cold brew has been a huge success in the US market, as an example. And this whole notion of serving something that's ready to drink right away and that's chilled is going to be very important to us, and we're pursuing it aggressively. And I think we have lots of avenues, both internal and external. Blue Bottle also offered a very nice ready-to-drink variety that we intend to build on aggressively. So this whole notion of not missing out on that major trend that will be very, very relevant, especially when it comes to Asia, is a key notion that I want to leave you with. And last but not least, moving to the geographic analysis, the bottom right, just take note of that huge difference in per capita consumption between some of these emerging markets and then the rest of the world. there's plenty of upside, there's plenty of runway in the coffee business yet to come. We're poised to take advantage of it. If you're wondering, well, how can you turn around a tea drinking market such as India and China? In all modesty, we've done it with enough perseverance. We've done it in the UK, we've done it in Russia, we've done it elsewhere. So with enough patience, this is where long-term thinking comes in. Yes, you can turn these markets, and we will certainly do our best to turn these markets as well. Next up, pet care. In all modesty, this is a significant success story. The beginnings of the pet care business came to us with the Carnation acquisition in the late 1980s, and I think since then, we've been building on it patiently, product by product, brand by brand, and we've been building it into a globally recognized competitor. And along the way, again, you're having a significantly attractive category here that we took advantage of. And there are really two key drivers. I mean, in most developed Western markets, pets are seen more and more as fully entitled household members, and hence the willingness to spend on them is significant. And then when it comes to emerging market, the name of the game is caloric conversion, and that is moving from feeding pets with household leftovers to specific pet food, as a result of more convenience or health benefits that are associated with this. So these two trends really fire up the growth behind the pet care segment, and we're committed to taking advantage of it. And in market after market, what you see us do is, in a sense, build our market share patiently over time, closing in on the leading competitor, or in some cases, building our lead where we lead the market already. Same thing here. I won't capture all of the specific strategies we're pursuing. Let me just highlight two. One is at the top row, the center, this whole notion of expanding the natural portfolio. So natural in pet care is no longer just a phenomenon that's reserved for the top end of the product range. This is really something that happens at all price points, and we're actively, aggressively converting our recipes to take advantage of that trend. So this is a big deal. This is something we're working at patiently. We're making very, very good progress. You're seeing some relaunches. We're starting in the US this year, and I think they're already starting to pay off. And then bottom row at the center, I want to point your attention to this whole notion of e-commerce in pet food, which I think is really important. When you think about some of these bulky packages, like that 50-pound bag of dog food for your hunting dog, it doesn't take a whole lot of convincing to convert people from carrying that home on their own to actually ordering it on the web and having it brought home. I think here again, we're in hot pursuit. We're working very, very hard with our e-commerce team to increase our footprint. We're growing above the market in those pet food e-commerce activities. We have lots of initiatives underway. We've developed specific packaging with some online retailers. We've developed lots of things that really make it easier to do e-commerce with pet food products. We're deeply committed to it. And again, as part of the overall e-commerce update later today, I hope we will leave you with that confidence that the company is at the forefront of digital opportunities in pet care in particular, but also in other categories that we serve. Water, another success story. Roughly the same time frame, coming from the late 80s. Now, the late 80s was the time when most people were still trying to decide on who would ultimately win the cola wars. Remember? Yeah. And the answer is no one cares. Okay. And at the end of the day, what happened is water won it. And water in North America last year, bottled water consumption for the first time has increased beyond soda consumption. And I think there's a tremendous success story that the company bet on very, very early, very patiently, and then brand by brand, location by location, was building it to the market-leading position you're seeing today. Full disclosure, many of you know this, the profitability of water is not quite up at the level of the three other categories. I think that has a lot to do with the fixed cost that's necessary in logistics. Before then, over time, you get some scale and get some leverage into the system. But it's improving, and I think as we're building out the scale and size of our water activities, you will see good news in the future there. So again, Tremendous growth characteristics, and it's one of those examples where I think the margin alone can be misleading, where I think a look at capital returns and when a more holistic look at the financial profile of a business gives you the truer picture. Two items here I would like to highlight. First, the top row, left-hand corner, this whole notion of functional water. Stefan mentioned to you in the break, we'll be serving you one of the products from our test kitchen. My personal impression, I love it. Okay, so here you get your hydration, you get your caffeine fix, and you get a good dose of antioxidants all in one go. And you get it also with some interesting taste. So have a try, let me know what you think. Second item, bottom row, left-hand corner. Here's another direct business that also benefits from digital presence that I think is often overlooked, and that's our Ready Refresh business in the US. And this is basically the old-fashioned water truck with a digital storefront. So on your app, you order what you want to order, you enter your subscription, whatever you want to buy, and the water truck brings it to you. And just like with pet food, it doesn't take a whole lot of convincing. Water is a bulky product. Your weekly shopping trip gets a whole lot easier if someone else takes care of the water. And this is essentially what we're doing. Successful business, and my message to all of you who tend to think that our only real successful direct business is Nespresso, no, we have plenty more to offer, and this is one of them. And last but not least, for the food and beverage high growth categories, infant nutrition. I think few recognize, few doubt our leadership in this market, and also the importance when it comes to sheer profitability. We did have, as you know, in the past, some growth issues. I think this is something that applied to the entire category. The last few years, a lot had to do with the properties and the growth characteristics of the Chinese market. I think a lot of this is on the mend, but you know, this is the category that the company was founded on. We're deeply committed to it. We believe that in the mid to long term, there's a tremendous growth and profitability opportunity, and hence we're committed to building it. And just like with the other categories, let me highlight a few items. One is the top row, left-hand corner and center. This whole notion of being in those geographic areas that promise to be high birth rate areas going forward. I think we do have an amazing footprint, a footprint built on history that really will capitalize on these high birth rates going forward. And then, in particular, when it comes to the Chinese market, with this deeper push now into third and fourth tier cities, I think we also will have a better chance to benefit from the growth opportunity that this market offers. So that's a big deal to us. And then at the bottom, when you look at that center picture and the one on the right-hand side, I would want to assure you that while we were a little slow to recognize this whole natural organic trend when it comes to baby food, we're deeply committed to making it a success now. We have completely revamped and repositioned our Gerber product line. It's being launched and rolled out in the US as we speak. And I think we're meeting market requirements now in a much better way than you see with the old range. And hence, I think this is another one of those cases where, yes, we may have been a bit slow to react, but I think we're reacting aggressively now, and we will set it right. Before moving on to the other growth initiatives, so after the 4 food and beverage high growth areas, let me describe to you the consumer healthcare environment in that same vein. Because you're seeing from the market size and from the growth rate very similar characteristics to our 4 high growth segments in food and beverage. And as you know, we're having 2 vehicles in that space. One is Nestlé Health Science, and the other one is Nestlé Skin Health. On Nestlé Health Science, and in particular the medical nutrition rollout over the years, I think there's little doubt that this has been a spectacular success and one that has been quite accretive to the company over the years. I know with a lot of you, there's more doubts surrounding skin health. And I think a lot of that has also been fueled by the fact that we did not disclose results of this unit separately. And while we're building it up, we will also not do that going forward. But I felt it was important to give you a bit of color on what went wrong. And I'd like to do this in particular because I noticed from some of the questions coming up, there was an increasing doubt, like how attractive is this category? And I can tell you it is attractive. That was not the issue. What we were suffering from in the past few years is basically self-inflicted issues. And what happened here under an old leadership team, going back to the times when this business was still run as a joint venture between us and L'Oreal, this business was over-relying on the earnings stream that was coming from branded RX prescription products, very profitable products. And on the back of that earnings stream, the company wanted to expand very aggressively into consumer skincare products. And as you know, when you're scaling something up, it's one thing to be aggressive, but if you overspend, you don't necessarily make it so much faster. And what happened then on top is that some of these patents that were boosting the RX side of the business between 2012 and 2017 were challenged and fell away. There goes your earnings stream. The company didn't react in time. It kept overspending on that consumer side of the business. And it all came to a head last year where basically you couldn't deny the bad news any longer. We changed that management team. There's a new management team in place. We took fairly energetic action. The new team now, some of you have seen the public news, is aggressively right-sizing the business. That involves administrative functions across the board globally. It involves some manufacturing. You may have seen the news that we're closing a site in Switzerland. We published that a few weeks ago. And it also involves basically a good review going forward when it comes to our R&D activities. To give you a sense of scale and to set the record straight, skincare alone, last year, 2016, as a result of that really negative performance we've seen, diluted the group OG by 20 basis points. So the 3.2% you've seen for the group without skincare would have been 3.4. Not 5 or 6, I understand that, but nonetheless, you know, if one business that size dilutes it that much, you can imagine there was bad news. And on earnings, it was even worse. On earnings, our trading operating profit got diluted by 40 basis points. So the 15.3% on trading operating profit that you saw could have been 15.7. This is how much the business pulled it down. The reason I'm telling you is that I thought a lot of you were not giving us and the rest of the group sufficient credit for how much we were really growing and what our true profitability was. But I felt setting the record straight and also giving you the explanation why this happened, not because of underlying lack of attractiveness, but simply because of that situation that led up to overbuilding structures and then reacting too late. I felt that really should help to set the record straight. On the consumer side in particular, and also on some of the aesthetics and corrective side, and selectively on RX products, we do see an interesting future, and we also see a strategic fit with the company. Now, if you're wondering, strategic fit, is this a lot of corporate hot air? Do me a favor, in your break, you Google the words anti-inflammatory diet, and you Google the word skin with it. And then you see that leads you back to the very same things I've been talking to you about all morning, and that is healthy food and nutrition. And you see that there's actually, from the inside, from the outside, that there is a very close correlation between the two. So when it comes to the underlying science, there is a connection, believe it or not. I think it's gathering steam. I think it's getting traction, it's getting more credibility. So I believe there is a connection that we can pursue. What we now need to do is put our restructuring program in place, make that take hold and make that work, and then once that is put in place, carefully, cautiously, prudently scale up and expand that business. That's the same approach we've been taking with our Nestlé Health Science products. I think this whole notion when you're trying something new of not getting ahead of yourself, but rather taking it in cautious steps, learning the lessons you learn, digesting those, and then moving on to the next thing. This is how you create value. If you're getting ahead of yourself, usually, and especially in healthcare, the result is predictable because then you're destroying value. So this is basically how we approach this business going forward. But on that basis, and with that sense of realism, I would also want to assure you that we're committed to it. Same as with the other categories, here are a few strategies we're pursuing. Let me focus on just one, And that's the top left-hand corner and this whole notion of active aging. Because I think both on the medical nutrition side and also on the skincare side, this is where we tap into a group of customers that does have a lot of disposable income and purchasing power, and that is aging baby boomers. And I think we're fulfilling a real prevalent need. And just to give you a sense how you create value in this space, it's all about combination of ingredients. When you stand at a Boots pharmacy here in the UK, or Walgreens in the US, or a CVS, in front of the dietary supplements or vitamin rack, and you see all these suppliers, and they all look the same, you kind of wonder, how is it possible to make money in this space? And the answer is, it probably is hard. So if you go into individual ingredients, you get commoditized really quickly. There's very little differentiation. Once you get, however, into combinations of some of them that are supposed to fulfill a specific purpose, and once you have the proprietary science to back that up, then things get a whole lot more interesting. So what do you need with a specific disease pattern? So for example, in medical nutrition, as you move from calories to disease-specific medical nutrition, then things get really interesting, and this is what we're focusing on. So combining some of these very same ingredients, backing it up with science for a certain purpose, from pregnant mothers to basically aging diabetics, and then really getting a proprietary product that fulfills that specific purpose. That's where you create value, and I think that's something that we're committed to. So this was a long section on the categories. Let's not forget geographies and our commitment to emerging market growth. And here again, the same thing applies as with the high growth categories. Let's really selectively advance our market position in those markets that really give us above par growth and profitability. So let's make sure from an OPEX, CAPEX, and M&A point of view that we capture every possible opportunity. What you're seeing here is based on 2016 numbers, that our organic growth in emerging markets was beating developed markets hands down. And then the third bullet point should also give you comfort. The profitability for us in emerging markets is higher than in developed markets. I think that's a unique feature. I think that bears testament to our long-standing presence in many of those emerging markets, as opposed to some of the people that kind of came late to the party, mostly then overpaid to get in, and are struggling to make sense of it now. When you look at the graph on the right-hand side, some of that success has been masked in the recent years simply by currency development. But that's why I felt it was important to look at the organic growth comparison between emerging and developed markets, because that relationship never changed. Emerging markets, whether it's now or whether it's 10 years from now, that is going to be a very, very safe bet for this company going forward. So that's the high growth categories and regions. The second one on my list was addressing underperformers. And we covered some of these businesses already, but I just wanted to reassure you that when it comes to taking energetic action, we're very committed to it. Case in point here is Yinlu. Wan Ling, as you know, is going to be the next speaker, and I can only applaud her for the aggressive action that she has taken to set the situation right. That was clearly dilutive to our China performance in the last few years, and as you see, the situation is on the mend. And that same principle, when there is a problem, to take aggressive action, do our homework, set things straight aggressively, we will uphold that principle on these other businesses and also situations that come up in the future. When you run a large company with all the best intentions, things do go wrong. It's all about how aggressively you go about setting it straight. Third, product and business innovation. You'll hear a lot about that later. In particular, Patrice Buller will cover some of this in the afternoon. Let me just give you a few high-level thoughts left to right. Clearly, it has to start with transforming the core portfolio, and this is what we're committed to doing, and keeping products and brands relevant against the backdrop of changing consumer tastes. Second, it's about creating and scaling new brands where that's needed, where we clearly see a perceived new need. And then the third one is also that willingness and openness to venture into partnerships or investments or outright acquisitions where we believe that a new platform is warranted. You've seen some transactions announced over the last few months that go into this category. I think Blue Bottle recently was one of them, Sweet Earth was one of them, and also our Freshly investment that Francois is going to be talking about later. For those of you who are wondering, well, how many can the company do? Let me reassure you, we have no intention of boiling the ocean. Okay, so there will be no future here managing hundreds and thousands of small startup companies. We're going to be very, very selective in how we do those. And the filter looks like this. It's either about a brand and a product that has already taken off and is ripe for scaling up, where clearly if we were trying to replicate the same thing, we would lose valuable time. Or it is about a skill set that we simply don't have to a sufficient extent. So think about Blue Bottle and their presence in cafes. While we had some promising efforts in other parts of the company, that full-fledged focus on the service side of coffee, that clearly is new to us, and there's a lot of learning for us, and hence it was worthwhile to go into that relationship. So we will be quite selective. We won't do dozens and hundreds of those, but I think where it's warranted, we will clearly be willing to invest in order to be exposed to these new trends and learn from them. But the core of the value creation clearly has to come from inside the company. This is why we invest in R&D. This is why we invest in new product marketing and launches. And this is the single biggest driver of long-term profitability. Fourth, embracing digital opportunities. I know this is a busy slide. No worries, I won't go through all of this. You will hear a lot about digital during the day. I just want to assure you that we're fully committed to this at all levels, in all regions. I also wanted to assure you that we're quite selective in how we pursue this, because internet and digital is not a one-size-fits-all global thing. The way we live and work with the internet is quite nuanced as you go from country to country. The Asian way of using the internet is quite different from the European or American one, and hence what we're committed to is developing the tools very aggressively, demanding from our management teams that they use these tools, but also being flexible when it comes to how exactly they're being applied in each market. But let me assure you, for us, digital, we see it as a huge opportunity, and it's not just a channel. It's basically an approach of doing business that's much more basic, much more fundamental. And then, last but not least, active portfolio management. We will need to trade out of some product areas and into others. We have announced some of this with our review of the US confectionery business, as an example. When it comes to the criteria for trading in and out, those have not changed from the past. And let me assure you that when we do trade, we will do this prudently. Unlike in your business, when a corporation trades in and out of product categories, the switching costs are much, much higher. Okay, so this is not just pushing a button and trading a share. There's usually fairly complex integration or carving out required to do a transaction, and hence it has to be thought through carefully, and we're committed to doing it. Once we're clear, we act decisively, and I think US confectionery is a good example of that. To give you a sense of scale, and also a sense of the fact that we're not talking just about polishing around the edges, I also, for the first time, at the bottom of the slide, indicated an order of magnitude. So we're thinking, at the present time, about 10% of group sales. So this is what over time, midterm, will change as a result of buying and selling. And that's really just supposed to give you some confidence here that we are actively thinking about adjusting this portfolio to be the best possible way in tune with what the market needs. While we talk about portfolio, let me also put to rest one rumor that frequently came up. Let me reaffirm our strong commitment to the US frozen business. And I know with some of you, that was a perennial question, like, isn't this bad? And when are you getting out of this? We are committed to this business. And I think that unjustly, this business has a bad reputation from the past when maybe some of the food offerings were not exactly NHW. As you've seen from our Sweet Earth acquisition, which is also frozen, in frozen, it's not about the delivery, it's about what you put in. And if you freeze healthy products, you get healthy products. That's the way it is. And so the whole notion of vilifying a supply chain, to me, does not make sense. We have a very strong frozen supply chain in the US. That's a source of competitive advantage. That's an envy to the industry. That's a huge barrier to entry to other people who would like to offer frozen. Let's use it to offer products that are in line with the market and also that offer NHW credentials. And I think Sweet Earth is one of them. If you have still doubts, let me give you one factoid and one little quick self-test. The factoid is frozen builds on a huge installed base. 90% of US households, more than 90% of US households have a freezer and a microwave. So again, when it comes to frozen, when it comes to meeting existing equipment to actually be used, there is little like it out there that is as prevalent as a freezer and a microwave. And here comes the self-test. I call it the late winter night self-test. You come home at 9 o'clock after a long day on a winter night with bad weather. And all you really want to do after a hard day is to have one quick, convenient meal. And then you want to go to bed. Okay? There is nothing that beats the convenience of just getting it out of your fridge, putting it in the microwave, and then 4 or 5 minutes later having that meal right available. Yes, you can talk about all the apps in the world, everything, direct, whatever. Try it. The problem is, the minute you hit the send button to order something, it doesn't mean it's there. Someone still physically has to do that. So if you had to battle bad weather on the way home, they will have to do that. If you were in traffic on the way home, well, they will be in traffic. I can assure you will not have it in 5 minutes. And you will also, more importantly, and this is important when you're squeezed for time, you will not have control over the timing. It might be 10 minutes, it might be 15, it might be 20. That voucher that your next order is for free is not helping you. Okay? So at the end of the day, the sheer convenience and control over what you're doing is unbeatable with this proposition. It's all about what you put in frozen. And what you see in addition to Sweet Earth and what we bought there, we also have some very, very interesting developments underway. Laurent Frex later on will talk about a brand that we developed in-house and we're test marketing now in the Cleveland region called Wildscape, where basically we're doing the same thing. We're going up market. We're going into healthier, better premium offerings, and we're committed to delivering delicious meals in a frozen way. I think we're doing this from a strong starting point with a highly successful frozen supply chain. I know we had a checkered past on this performance. I think we set it straight. We're now committed to building that business. So now, after this long section, and this is the last slide on the organic growth section, let me try and put it all together. Again, go back to the concern that some of you had voiced in the past, this whole notion that maybe 3% is the new 5%. Yeah, you know, in 2016 it was, but then you start correcting for some of the things that we now have to set straight, some of the things that were self-inflicted. You add on top of that some of the portfolio management opportunities, and you add this whole notion of selectively going for growth in these high growth areas that constitute half the company. I didn't separate out the math because I didn't want to go into micro-targeting here. I hope that's understandable on a 3-year plan. But the rough sequence here and also the rough order of magnitude that you see on the graph more or less hits it. So the smallest contribution will come from fixing some of these internal issues. The next one will come from portfolio, and the largest one will come from selectively going for growth in these high growth areas. With that, we've done the math. We will have a path back to mid-single digits by 2020. So that's a long section on growth. Next, let's go to our financial model. And let me start that section by recapping something that has served the company extremely well over 2 decades, and that I think a lot of you as long-term shareholders have come to enjoy, and that's the Nestlé model. And so on the left-hand side, you see the key attributes of this model as it was practiced. And on the right-hand side, you see a tool that we have used in-house a lot. It's called the virtuous cycle. And it basically describes the way we approach our business. You go for efficiencies, you take the benefits of that, invest in growth, build your market share. As a result, you get more efficiencies, and then the whole thing, you know, if you do it for 20 years, it delivers pretty amazing results. The reason why the Nestlé model was so successful is that what it describes, that steady improvement, was very much in sync with how the company lived and operated inside. And so you didn't have one of those awkward situations where some outside model was bolted on something totally different on the inside. This was in harmony. And when you pursue this in harmony over long periods of time in an industry that rewards that sort of behavior, you're getting fabulous results, and we did. Now, two shortcomings and two observations here after a period of tremendous change. One is, as you all noticed, the last few years, in this period of significant structural change in this industry, getting to that 5 to 6% top-line growth has been getting increasingly harder. And we missed it. There was significant structural change in this industry, and I think it also became a problem that for a model that's longer-term aspirational, that 5 to 6 is a very, very narrow band. So that's one issue. Second issue, going to the second bullet point, by focusing on trading operating profit, which includes then all restructuring expense, at a time of significant change in the industry, when you would want latitude to react fast and restructure if needed and right-size the business and adjust it to a new reality, it was putting us in a straitjacket. It gave us all very steady, very dependable trading operating profit results. But as you know, when you do restructuring, mostly in the first year, restructuring cost is greater than the benefits you get from it. Hence, your leeway of reacting fast was limited. And I think that may have led also to us adjusting a little slower than we should have done to that new environment that all of us have perceived over the last few years. So we're now committed to improving efficiency. You will have seen by now our press release from the morning and our 2020 margin target. We're committed on underlying trading operating profit. As you know, we reintroduced that measure with our Q2 results. We're committed to build that from the 16% that was the full year number for 2016 to a range of 17.5% to 18.5% in 2020. That is what we're targeting. Francois will talk about it in more detail later. This is the margin improvement that we're attempting to do. I know some of you, while you appreciate that there is a target, will have said, well, you know, why don't you aim for more? Let me remind you, building on the previous section, this is also that period where we're trying to boost organic growth. And hence, when you put the two together, this is when things get really, really interesting. From a shareholder point of view, but also, as you can imagine, quite challenging from a management point of view. So the two together are not easy. One of them alone, maybe a different cup of tea. But this is what we're committed to. And let me also say, for the sake of good order, while no one knows what the world will look like in 2020, as from what I know today, it is unlikely that this margin target will get followed by another yet higher margin target. And the reason simply is that I watched this current margin, quote-unquote, arms race in the consumer goods industry with quite some apprehension. As we discussed earlier, margin is not the only value driver. It is about the trinity of growth, profitability, and capital efficiency. If you maximize margin alone over time, I don't think you have a sustainable business model. Over time, I think bad things are going to happen. We have some catching up to do, hence that commitment to that margin improvement. But I think over time, what I would like to turn to is something that I'm trying to sketch out here. And that is a new Nestlé model that takes into account the new Nestlé reality. That is, again, much more in sync with how we live and feel about business. And that is a wider band on top line, so hence mid-single digits as opposed to 5 to 6%. And also a steady improvement in underlying trading operating profit as opposed to trading operating profit, while giving you full transparency on what the fully loaded trading operating profit is. So this is not about hiding bad news, but it is about improving the underlying trading operating profit and having the flexibility and the latitude to do the restructuring that's needed in a more turbulent world to stay aligned with reality. So that sort of mindset, again, captures the virtuous cycle that has never lost its relevance inside the company, That one is in tune with how we approach business. We will go through the period of margin improvement that you've seen, that we're highlighting here. We will go through the OG improvement, but I think longer term, again, rather than expecting margins to increase in leaps and bounds and creating lots of umbrellas for other people to basically drive into those markets, I think that steady improvement model is going to be a much more sustainable and Nestlé-like way of creating value. And so the intention is, from what I know today, to get back to that. That next slide is more about our job on the executive board than yours, but I just wanted to assure you that in order to get there, internal work needs to be done. The good news is we're not thinking about a top-to-bottom reorganization. That is not needed. I think one of the good things is that Nestlé, over the years, in a day and age when other companies over-centralized, never lost its close connection to local markets. But I do think there's a consensus that inside the company and outside the company that we have to speed up, we have to drive agility, simplicity, and cost consciousness at all layers in the company. And this is basically what we're committed to. So we will make it happen. We'll do it the Nestlé way. We won't lose our approach, our healthy approach to business. But I wanted to show you that work is underway and will continue. L'Oréal stake. First and foremost, on a personal level, let me do what we did as a company last Thursday, Friday, and that is to offer my personal condolences to the Bettencourt family over the passing of Madame Bettencourt. As you see, this has been a very close, a very long-standing partnership. And as you also see, this has been a fabulous investment for the company, no question about it. You see that the contribution to our earnings is not that far away from the share of market cap that it represents. And hence, this investment is not diluting anything. It has been a good thing for the company. And as for today, I just wanted to be very open because I know there were lots of questions coming up out of last week and over the weekend. Our approach to this investment is currently not changing. So I just wanted to put that clear. What you've seen from my presentation and what you will see from the other presentations is there's a lot of change in our main business, the other 90% of our market cap. We're fully committed to making the best out of those changes for us as a company, for you as shareholders. I think this is the single biggest way for everyone to create value. Let's focus on that. Let's keep first things first. Before closing, and without going to the detail, I know a lot of our investors are very interested in sustainability issues. Since I have not spoken publicly about this before, I just wanted to affirm my allegiance when it comes to Nestlé's sustainable way of doing business. I think this gets captured really well in the creating shared value model, which is outlined here. And long before that term has been coined, Nestlé has been practicing this approach to business. I think it's a natural way of behaving when you're dealing with sensitive agricultural communities as suppliers, and when you're dealing with a product group as sensitive as nutrition. I think we've made a success of it. I'm committed to continuing going forward. And then, before my closing slide, just two personal comments. One is, I wanted to assure you that the entire executive board and leadership team is very, very deeply committed to making this happen. And this is a busy agenda. We recognize that. In particular, this combination of going for increased organic growth and going for an improved margin at the same time amounts to what I sometimes call in jest, going for a run and going for a diet at the same time. This is hard work, but we're committed to it. And I think there's a recognition at all levels of leadership that this is what we need to do. The one thing when people talk about the Nestlé culture, the Nestlé leadership team from the outside, the one thing that I can tell you after a year with the company that virtually all of you underestimate is that sheer pride and will to win that this company has. That you don't get. I never hear it. I've seen it, I feel it, and I feel it personally too. This company got for a reason to the leadership position it has today in its industry. and it's hell-bent on not losing it. It's hell-bent, if anything, on building it. And we're deeply committed to that. If that means taking in the changes that are happening on the outside, adjusting to it and making the most of it, yes, we will do that. On a personal level, let me say very clearly, when it comes to this opportunity, I am, to borrow a term from poker, all in on this. I've given up all outside corporate boards. I've given up anything on a not-for-profit basis I'm doing. I moved my family to Switzerland. I'm in for the long haul. I'm all in on this. And again, while I'm the first one that recognizes that effort alone doesn't get you there, I'm also a strong believer over the course of my management career that without sheer effort and intensity, it all amounts to nothing. And so again, I can assure you the effort and the intensity is going to be there, not just personally, but I've also seen it from the entire leadership team. Hard work is not what's missing here. It's there. And so putting these two together, as you go now, as you join us on this journey going forward, there will be great days when things really fall in place. And there will be days when maybe there is bad news. But I want you to have that confidence that there is a leadership team and an executive board, and there is a CEO that make it a matter of personal pride and a matter of ambition to succeed in this environment and make the most of it. And please, over all the hard data, over all the concerns about incentive systems, what have you, do not forget that and do not underestimate it. It's a source of strength in this company that I've found to be stronger than anywhere else I've seen. Last slide, I promise. We didn't wait for this Investor Day, okay? I'm sure you noticed we're on our journey already. And you're seeing here some of the initial steps that I think already show you the handwriting that we practice. And I think, and I hope, that you see that most of these steps are consistent with the messages I gave you this morning. So on growth and portfolio, a lot of work done already. I know that these are not investments that collectively move the needle very much for Nestlé. But again, we have a pipeline, we have interesting things to work on, we have a direction, and it's commonly shared. When it comes to efficiency, I hope you noticed that over the spring and summer, hardly a week has gone by without another announcement that is about actions that we're taking to improve our efficiency, and that'll continue. And on balance sheet, you've seen our commitment from late June, the intention to improve leverage, and I hope you all noticed from the press release this morning, and when it comes to the spacing of our share buyback program, we're now going for an evenly distributed model over 3 years, which basically pulls forward the share buyback program from what we told you in late June. So again, we're on that journey. I think these steps, in addition with a lot of internal work we're doing, address what is important to us, and that is the need for organic growth, for efficiency and capital efficiency at the same time. This is what we're pursuing going forward. That concludes my presentation, my remarks. As Stefan said, I'll be happy to answer your questions alongside with Francois in the afternoon. Let me spend a minute to warm the stage for the next speaker, and that's Wan Ling. And let me say, with a lot of professional admiration, that what Wan Ling has done over the last 2 years to this zone AOA is simply amazing, absolutely outstanding. Here is a zone that has so many good things going for itself on a fundamental level. When Asia is such a safe bet, Sub-Saharan Africa has been a long-standing performer for our company. So these are countries, these are markets that hold so much promise. And we've had such a long track record in them. And yet, over the last few years, they've given us a good share of trouble. And she has moved about very decisively, very aggressively to set things straight, and I think we're seeing the results. And this zone, I think, is rightly now getting the attention and getting the outside recognition and value that it truly deserves. In doing that, what I particularly admire is the combination of 3 things. One is, when things were clearly weren't going right, to take very aggressive, very decisive action and to put things straight. And I think this is in line with the approach that we're practicing elsewhere now too. Second, in markets that are growing naturally, when it's not about micromanaging, when it is about letting the bulls run, well, you let the bulls run and you encourage them. And I think this is what she's been doing in a very successful way. And then third, in Asia, without a good and winning digital strategy, in our industry, it's over. And hence, being well-versed in this digital environment, being one of the thought leaders, I think, was particularly helpful to her in navigating some of these opportunities. This is also what part of her presentation is going to be about, how we're using digital and how it's deeply embedded in those business models to drive our competitive stance there. And again, in summary, it really amounted to a stunning recovery and turnaround for that zone. Wan Ling, that was my stage warming for you. Looking forward to your presentation. Thank you.